Hello, I'm John Bulbrook. Thanks for joining me. You will find the current deal list immediately below this video. A lot of clients will tell you right off the bat that they think that deals that make sense for them are the short-term deals. And of course, we understand. Everybody wants the immediate pay deals. The issue is, though, that a lot of these people have financial planning needs that extend well into their 70s and 80s. Whether they like it or not, it's a question of getting beyond the I only want immediate pay deals. So if you have a client who is 60 years old, does he or she have long-term care insurance? Do they qualify for long-term care insurance? Do they want to pay for long-term care insurance and then never need it because of one ailment or another? Or maybe they live a long, healthy life and never need it for any reason. Our long-term deals, where you can lock in a payment now, 15 or 20 years ahead of time, are unique in that you have tax-deferred growth up to 6 and 7% compounded. In the case of the long-term care example, your client retains the funds whether they end up using the funds for long-term care or something else. Another example is someone who has a 3-year-old grandchild. I think we all have clients who have young grandchildren and clients who have $50,000 to $100,000 that they would like to earmark for the grandchild's college education or something to pass on to a disabled member of the family, where a $50,000 or $100,000 purchase could wind up being 5 or 10 times that amount down the road. Basically, what I'm asking people to do is to think about different reasons that well-to-do clients would have to purchase payments that start in 15 or 20 years. Obviously, the average client, when they look at a fixed income product, is thinking about their immediate near-term needs. They are thinking about the income stream that they want to maintain in their own retirement. They're thinking about short-term, where we would argue that we all have long-term needs, even if we are 60 or 70 years old. Even your 70-year-old client has a 15 to 20-year time horizon. If you are 70, chances are, if you need long-term care, it's going to happen around age 85. Why would the client who is worth $2 million and is 70 years old put $100,000 away for 15 years when he may never need it? Because they are going to want a high level of care. And our product is a perfect instrument to cover some of those costs. And let's look at wealth transfer, for example. You've got someone who is worth $5 million that wants to skip a generation and leave substantial money behind to grandchildren. If you have someone who is worth $2 million to $5 million who is 70-year-old and has 4 or 5 grandkids, if he puts $200,000 away or even $100,000 away now, that comes due in 30 years, you can get out of some of these longer-term contracts 9, 10 times what you put in, and you can also gift the ownership directly to your grandchildren or set up a trust that will receive these payments when they come due and then pay them out and pass them along to your heirs as the trustee sees fit down the road. It's a very efficient way to transfer wealth, and it's one of the few things available anywhere that guarantees you 7 to 10 times your money back, and you can make this not part of your estate. Now, obviously, you would want to work with attorneys and tax advisors to find out what works in your own state and what works in your own situation. But this is a very efficient way of transferring wealth. You think that every one of your clients wants something that starts immediately. They don't. They just need you to educate them as to why these make sense. You have got 3 grandchildren between the ages of 1 to 5. Why wouldn't you put something aside for 20 years that comes due for them? Let them take out their loans. Let them do whatever everyone else does, and maybe the family helps them, or maybe they try to help themselves pay their way through college. Then, when they are in their 20s, after they have already been through school, this money starts to materialize to help them pay for their loans, their school, and what a gift. You transfer these funds at a very low cost to the grandchildren or their trust. Let's say that Grandpa puts away $150,000 now. The payments start in 20 years and go through 30 years. You are making 6 times your money. You put away $200,000 now. It's $1.2 million that comes out to your grandkids over that period of time. And unlike a Section 529 plan, if they don't use it or they get a scholarship, that money can be used for their first home purchase or to put away for their own retirement. As long as the trustees are comfortable that they are doing the right thing with the money, it's their money to do what they want. If they want to pay off their school loans, they can pay off their school loans. If they want to apply it to something else, they can apply it to something else. A lot of our clients tell us, look, I only want something that starts paying immediately. And we have those deals. But if you dig down below that first level and ask them if they have any long-term care insurance, well, no, I don't like insurance. And if I have the big one or get cancer, I'm never going to use the long-term care insurance. It's a waste. Why should I pay $10,000 or $12,000 a year for something that I'm never going to use? Well, okay, Bob, you are 65 years old. You probably wouldn't use it for 20 years. Let's hedge our bets. Let's put $100,000 aside in something that comes due in 20 years. You've got $600,000 to $700,000. If you or your spouse does not need care down the road, you've got this pot of money. And you know what? If you never use it, go on a vacation with it. Spend it. Or give it to your grandkids. Give it to whomever. But it will be there, and it's guaranteed. It's not like a long-term care policy where you buy it and it's not there. Everyone in this economic class knows that long-term care planning is one of the biggest hurdles that we face in financial planning. Here's a unique way to solve it. The best part about it is that you don't have to use it for long-term care if you don't want to. It's there, unlike actual long-term care insurance. You don't have to use it that way. I hope these ideas are helpful. There are many deals on our deal sheet today offering a wide range of payouts and schedules. Review the deal sheet and give me a call. Thanks for joining me.